Micron just reported earnings and the numbers were record-breaking. Their memory chips are arguably the most important component in the AI build-out. But does that mean it's time to buy the stock, or has the valuation disconnected from the fundamentals? The company beat analyst estimates for both revenue and earnings per share. Micron's revenue came in at $41.46 billion, much higher than the estimate at $35.84 billion. Earnings per share came in at $25.11 per share, beating the $20.78 estimate. The wide margin between the reported numbers and the estimates suggests that investors had been underestimating Micron's potential, which is why the stock jumped over 15% after the announcement. Now we're going to take a look at what Micron's management team actually said during the earnings call. Fiscal Q3 2026 was a record quarter. Revenue, gross margin, and EPS all exceeded the high end of guidance. Total revenue was $41.5 billion, up 74% sequentially and up 346% year over year, making it the fifth consecutive quarterly revenue record. And if we take a look at Micron's quarterly revenue chart, you can see the growth is almost unbelievable. For most of the past 10 years, Micron's quarterly revenue bounced between $3 billion and $9 billion. Now they're generating over $40 billion in a single quarter. We'll get into the details of why their revenue is exploding in a moment. The sequential or quarter over quarter revenue increase of $17.6 billion was the largest in Micron's history. Micron's gross margin reached a record 84.9%, up 10% compared to last quarter, and more than double what it was a year ago, driven primarily by higher pricing and revenue mix. This is where the story really starts. If you didn't already know, Micron's entire business revolves around producing memory chips, basically the technology used to store information digitally. This technology is crucial for cloud providers like Alphabet, Amazon, and Microsoft, who are spending hundreds of billions of dollars to build new AI-enabled data centers. The only problem is that their hunger for memory chips has created a supply shortage, meaning Micron now has the ability to charge premium prices for what is essentially a commodity product. But the real question is, how long is the shortage going to last? And are Micron's record profit margins actually sustainable long term? Now we're going to take a look at the 3 key points from Micron's earnings call. The first key point from Micron's earnings call is the discussion of SCAs, or strategic customer agreements. These are basically long-term contracts with their largest customers to supply memory chips. These long-term contracts are incredibly beneficial for Micron because they increase the predictability of their revenue. As you can see from this chart, Micron's revenue is usually quite unpredictable, mainly because the memory chips that they sell are seen as a commodity product. But with skyrocketing demand, Micron actually gains the ability to negotiate very favorable pricing. Micron have signed 16 multi-year SCAs with customers across data center, consumer devices, and automotive. These agreements cover roughly 20% of DRAM volume and about 1/3 of NAND volume over the agreement period. When all planned SCAs are executed, Micron expects approximately half or more of the company revenue to be under SCAs. This means that by the time all of Micron's SCAs in the pipeline are signed, half of the company's future revenue is contractually guaranteed. Micron's SCAs are generally 5-year terms from calendar year 2026 to 2030, structured as take or pay with binding volume commitments. What this basically means is that whatever happens in the wider economy, Micron's customers have to take the agreed volume of memory chips or pay anyway. The largest agreements generally have floor and ceiling prices. The ceiling is set at the current Q2 market price levels, and the floor price is well above margins achieved at prior peak cycles. Some agreements use fixed prices or have no price bands, meaning that pricing will follow the market. When all targeted SCAs are signed, agreements with fixed prices or ceilings at or near current Q2 prices are expected to be 40% of Micron's revenue. So this basically means that revenue from their long-term agreements carry similar margins to that of recent quarters. At minimum floor prices, 14 of the 16 SCAs represent about $100 billion of cumulative revenue over the remaining terms. Management expects actual revenue to well exceed this RPO figure. Just to put that into perspective, these agreements, which only include around a quarter of Micron's total supply, make up $100 billion in revenue over the next 5 years at the minimum agreed price. Times that by 4 and you've got $400 billion in revenue spread over the next 5 years if supply in the wider economy remains constrained. Speaking of constrained memory supply, that's the second key point that Micron's management team discussed in the earnings call. But before we see what Micron's management said, I wanted to provide some context. Micron, based in the US, are one of three main global suppliers of memory chips alongside two South Korean companies, Samsung and SK Hynix. They collectively control roughly 95% of the market for high bandwidth memory, or HBM for short. HBM is the most advanced and profitable memory product and is in high demand for the AI data center build-out by the hyperscalers. Due to the high margins that come with HBM, the big three, Micron, Samsung and SK Hynix, are prioritizing those products in their manufacturing plants. However, this prioritization of HBM has inadvertently created a shortage of the less advanced but still highly demanded DRAM and SSD products, which is why every part of Micron's business is growing exponentially, because the shortage increases prices. You might think that these companies can just open new factories to meet the excess demand, but it's not that easy. These facilities take around 3 years to become fully operational and can cost between $15 to $25 billion. Micron states DRAM and NAND industry demand continues to significantly exceed supply. Tight conditions are expected to persist beyond 2027. Even with some supply improvement in 2028, Micron does not yet see clear timing for when supply can fully catch up with demand. So based on what Micron's management team have said, it looks like Micron's record margins are here to stay for at least the next few years. Then the third key point from Micron's earnings call was their guidance. Basically the company's official projections for future revenue and margins. For the next quarter, Micron are projecting $50 billion plus or minus $1 billion in revenue, which is another record, with their gross margin at 86%. Earnings per share is expected to come in at $31 plus or minus $1. The company's management team then gave some more details about profit margins. Q4 margin outlook assumes a meaningful moderation in the rate of price increases compared with prior quarters. Management notes that at current absolute margin levels, incremental price increases yield less marginal expansion, but believes structural tightness, product mix shift to higher value memory, and new capacity absorption will support strong margins over time. Floor prices in SCAs are said to support gross margins well above any prior peak in company history. Management also gave an insight into their long-term industry view. Memory is described as a structural strategic asset in the AI era, central to AI performance. Micron sees strong, durable long-term demand for memory and storage across data center, edge, automotive, and robotics. Structural constraints on supply growth even as large fab projects ramp. Continued tightness in DRAM and NAND markets through at least 2027, with supply only gradually improving in 2028 while demand remains robust. SCAs are characterized as a major structural shift for the industry and Micron's business model, aimed at enhancing durability and predictability of financial performance. Now we're going to take a look at the valuation of Micron stock. When looking at Micron's PE ratio, you will notice something very interesting. Micron's trailing PE is 26, but this is based on their earnings from the past 12 months. As investors, we have to base our decisions on what we think will happen in the future. And as you can see here, Micron's forward PE ratio is just under 9. The reason why it's so low is because Micron's earnings are expected to grow substantially over the next 12 months. But this is the problem with Micron. The valuation looks incredibly cheap on a forward earnings basis, but we can't be sure that the current profit margins are sustainable long term. Personally, I think due to the demand for HBM, which is structurally a higher margin product because it's more complex to produce, means Micron's margins will remain elevated long term, but probably not at the current level. I think it's possible that we'll see Micron's operating margin settle at around 40 to 50%, which is still a big improvement on Micron's margins in the past. Next, I'm going to run you through my base, bear, and bull case assumptions for Micron stock. Using Qualtrics' DCF calculator, we can project the expected return from Micron stock over the next 5 years. First, we have my base case assumptions, which include 30% earnings per share growth and a 20 PE multiple. 30% EPS growth is actually pretty conservative compared to many analysts on Wall Street who are projecting upwards of 40% growth. And a 20 PE multiple seems pretty reasonable for a company with operating margins settling around 40 to 50%. So in my base case scenario, Micron stock would increase from roughly $1,200 to around $3,300 per share in 2031. That's a more than 22% annual return, or a 3x increase from today. Then in my bear case scenario, I'm projecting 20% earnings per share growth with a 15 PE multiple. These results don't look so good. In my bear case scenario, Micron stock would increase from $1,200 to $1,650 per share in 2031, generating annual returns of just 7%. Now for my bull case assumptions, I'm going coming with 40% earnings per share growth and a 25 PE multiple. In this scenario, Micron stock would increase from $1,200 to $6,000 per share in 2031, generating annual returns of 38% or a 5x increase from today's price. You can see from the huge difference in returns from my bear and bull cases that Micron is a highly unpredictable stock, and personally, I don't like unpredictable stocks. I want the businesses I own, which is what stocks are, businesses, to be highly predictable compounding machines, like MasterCard or Netflix, so I won't be adding Micron to the portfolio. However, this isn't a judgment on the future performance of Micron stock. I believe it's likely to double or triple within the next 5 years. However, my worry is the 5 years after that. Is demand really going to sustain 50% operating margins indefinitely? I doubt it based on the history of the memory chip industry, but that's just my thoughts. Let me know what you think about Micron stock in the comments. Don't forget to like the video if it provided value and subscribe to the channel for more investing content.